Hi, Martin Turner here. This week we look at restating our firm's income statement and discuss tips and commonly asked questions about doing this. You will be reminded about the popular videos where Maria takes us through, step by step, how she restates each of the financial statements for her firm, Wesfarmers. We start with reminding ourselves about the purpose of restating financial statements in our unit. That is, to become more familiar with each item in our firm's financial statements and to help us link cells between worksheets in Excel. Hi, Martin Turner here, and welcome to our Week 7 lecture, Analysing Financial Statements for ACT 11059, Accounting, Learning and Online Communication. Now, our agenda today is we're looking at restating, and we're going to remind ourselves why we're doing it. Particularly when you're restating your income statement, you might be asking yourself that question. And then we're going to look at some common questions and some tips on how to restate your income statement. And then we'll have a minute paper. Why are we restating our financial statements? We're not learning about how to restate, not learning about restating financial statements. We're learning about financial statements. It gives you a chance to look at each item of your financial statements and just be introduced to them a little bit. Remember, it's just introductory accounting. We don't have to drill into everything. We're just having a little bit of a look. Also, it's helping us to learn to use Excel. We're linking cells between worksheets. That's a key thing. You get lots of practice of that. Also, you can look at various ways of formatting and Format Painter, quite a few people are getting introduced to, and so on. So that's why we're restating financial statements. You're getting to know a bit better, my good friends, the financial statements, and we'll particularly look at the income statement today. Some common questions. I only have one income statement. Where's my other one? A lot of firms have two income statements. And like Ryman Healthcare has a income statement and a statement of comprehensive income, separately. Other firms just have one income statement. It might be called a statement of comprehensive income, which includes both. So one way or the other, you'll have one or two income statements effectively. If you've got two income statements, as many people will have, like with Ryman Healthcare, you just flow the statement of comprehensive income straight after your income statement. Your income statement or your statement of financial performance, its bottom line is your net profit after tax. And then if you've got a separate statement of comprehensive income, it starts with your net profit after tax, goes through the other comprehensive income items, and then you end up with total comprehensive income. So when you put in your spreadsheet, you just run it straight through. The income statement ends at net profit after tax, and the statement of comprehensive income takes off from that. So you just flow it through. You don't have to repeat the net profit after tax. You just flow it right in afterwards. There's a phrase we can use called, what's your bottom line? What's the bottom line of something, which is sort of the end game, or the thing that's most important. And so that's come from income statements. The bottom line is the net profit after tax. That's the most important thing. And then when we add in the comprehensive income statement, the bottom line is total comprehensive income. Some people ask, what do the little brackets around the numbers mean? By convention, we often in accounts put brackets around negative numbers. So in your financial statements, if you've got some negative numbers, some people make losses rather than profits. You'll typically have some brackets around those negative numbers. So that's what it means. When you input the numbers, you input them in as a negative number. Like if you had 100,000 with brackets around it, you would put minus 100,000 into your Excel. When we format the cells, we can format the cells so that negative numbers show as numbers in brackets. So you get a little bit of practice too of seeing the difference between inputting numbers into Excel and their presentation or format of the cells. So you input them as, say, minus 100,000 and present it with brackets. What you don't do, you don't input them as bracket 100,000 bracket. The reason that doesn't work in Excel is that you can have labels or numbers in Excel. So you can input a label, which might be some words, and so if you put a bracket first and then the number and close bracket, Excel will think that is a label, not a number. So, but if you enter it as minus 100,000, it'll recognize it as a number, as data. So that's an important distinction when entering items into Excel. There's a whole heap of lines underneath my total comprehensive income line. Do I have to enter or restate these? You might notice at the end of your income statement, there can be earnings per share and dividends per share. There can be some, or just different types of earnings per share. And there can be some other things as well, but often that, almost invariably that. And you don't have to enter anything below the bottom line. The total comprehensive income, you can just ignore what's underneath that. We won't be using those. There are some requirements around presentation for the financial statements. I've said in the past that there are no rules for presentation of financial statements. People can do whatever they like, and that's largely true, but there are a few little rules around presentation and requirements in Australia. And one of them is to show those basic and diluted earnings per share figures at the bottom of our income statement. So that's why we've all got them. You don't have to enter them in. If you have entered them in, that's fine. And we don't have to do anything with them. And some people ask, well, what is basic and diluted earnings per share, EPS earnings per share? Basic earnings per share is earnings per share. That's your net profit after tax divided by the number of shares. Diluted earnings per share is where the number of shares is diluted for any options that are outstanding. Your firm might have issued some options, perhaps to senior staff or other situations. And those options give the holder of the option the choice to, or option to exercise that option to buy those shares at a certain price. So the company's issued the options. It hasn't issued the shares yet, but the diluted earnings per share is based on as if the options were exercised and the number of shares has been increased. And so they have the diluted earnings per share as well. When we do ratios, you'll calculate earnings per share and you might get a number different. Quite likely, we'll get a number different to the basic or diluted earnings per share your firm has calculated. There's many ways of calculating ratios. How to restate? Most people have found Maria's videos really useful. It's in the unit introduction tile. Also, there are links in assignment 2 to Maria's videos. So we had the statement of change in equity in the balance sheet, and there's also one on the income statement. A lot of people watch the video, turn it off as they just write, as they're doing their spreadsheet, and just do it as they go. You may still have 1 or 2 questions after doing that, but often you can largely get it done that way, and then you can ask other people. There are also live links to Maria's videos in the slides in week 7. Chapter 4, pages 12 to 20, that's where we discuss restating the income statement. I take you through Ryman Healthcare. Maria takes you through her company, Wesfarmers, in the video. So you got the study guide and you got the video. Some people read the study guide first, then look at the video, which is how I would do it myself. But other people look at the video and then read the study guide. And so you can do it in many ways. The idea of the study guide is it's just introducing you to the concepts. You don't have to understand everything. But sometimes people can find that a little bit overwhelming, but you just have a look at it. And then when you go to the video, you've got a little bit of input already, and that can help you understand what you're doing. And then as you're applying those concepts to your own firm, restating your own firm's financial statements, then you can really understand more of what you're doing. In our capstone unit, financial statement analysis, at the end of the degree, if you're doing an accounting degree, we also restate financial statements again. And invariably, people say to me, people say it's a lot easier at the end of your degree. Like, it's really easy, but when they were doing it here in first year in Act 11059, it wasn't so easy. In fact, it was pretty frustrating sometimes. And the reason for that is that there's a few reasons, but one is you don't understand what these items are. A lot of them, you're not quite sure what they are. You're a little bit confused about what operating and financial activities are in a firm. And, like everything's just a lot new. But when people get to the end of their degree, if they've studied accounting, the items are much more familiar, they find. And so they become much more familiar to my friend, the income statement or the financial statements. And so it becomes much less daunting. But particularly restating income statement can often feel pretty stressful and daunting to people. We don't want it to be stressful. Don't feel stressed about it. Just work through it, and we'll look at some of the issues. So you work through your income statement, but what happens if your income statement, if there's some errors, or how do you tell whether there's some errors? We'll get to that in a minute. So you've got your net profit after tax, and then you've got other comprehensive income. What is other comprehensive income? Well, there's a little video, other comprehensive income. There's a link to it in this slide on week 7. It's very, very short, just taken out of a later unit. And it looks at what it is. Other comprehensive income is income that is not part of revenue. So income and revenue are slightly different concepts in accounting. Revenue only includes gains that are in the ordinary course of activities, the sort of thing your firm would do just typically. But income, it includes gains that are not in the ordinary activities. It includes more than just the revenue. So the revenue and the expenses, the revenue goes into the income statement, but the rest of income, the other comprehensive income, that is the gains that are not in the ordinary course of activity, they're shown separately. This is a slight oversimplification of it, but it's pretty good. And certainly good enough for us in first year. The income so other comprehensive income is the income not part of revenue, income or the gains that are not in the ordinary course of activities. And that's also why other comprehensive income, the items in there can seem a bit strange. And they can say, what does that say? But for those studying accounting, when you get to the end of your degree, all these items will, as long as everything else, will seem much more familiar. So that's what other comprehensive income is. So what if things go wrong when you're restating your income statement? And also, even if it seems all right, how can I check if I've got it right? Well, one issue is identifying finance income. So you've got to identify your finance income. For many firms nowadays, they're disclosed separately in your income statement. And then you've got to identify your company tax rate, and we'll look at that in a minute, and you type that in towards the bottom, as per Maria's videos. Include your company tax rate. If you're in Australia, that'll be 30%. And then you link the tax rate to the right part of your income statement. But what if you can't find your finance income? Some people go, well, wait a second, I haven't got it. I haven't got any. If you've got cash, check your balance sheet. If you've got cash in your balance sheet, if you've got some cash in your balance sheet, you will definitely have finance income because you'll have earned some interest on it. And if you haven't got finance income shown separately, have a look at revenue and see there'll be a little note next to it. It might be footnote 4 or 5 or 6 or whatever it is. Go to that footnote and see if you can find some interest income or financial income or finance income shown in that footnote. And that's typically where it will be if it's not shown on the face of your income statement. So you can find the finance income And then the company tax rate, you can go in the study guide, page 16, there's a link to the KPMG list of company tax rates in the world, by year over the last 10 years or more. There's also a live link to it here on this slide. And it's also in the assignment. You can click through and find out the company tax rate of your company based on what country it's based in. So if it's based in Australia, that'll be 30% over the last few years. It hasn't changed. Now, once we've calculated, we've got the company tax rate, we know the finance income and so forth. We've then got to split the tax between operating and financial. Why are we including tax twice? Some people ask. We're going to put an operating and financial. There's only one tax expense. Well, that's right. There is only one tax expense for the firm, and we aren't including the tax twice. All we're doing is breaking it up into two, operating and financial. We look at the operating income and the net financial expenses. We look at them after tax. The reason for that is that the amount of company tax our firm pays is affected by how much borrowings it has and how much tax deductions it gets for the interest it's paying. So if our firm borrows money, like Ryman Healthcare borrows quite a lot of money, it pays interest. The bank will want its interest, and a company will get a tax deduction for the interest it pays. And so we can calculate a tax benefit to our firm for its net financial expenses. So the more net financial expenses Ryman has, the more tax it saves. In other words, the more tax benefit it gets. So that's what we mean by tax benefit in this context. So we aren't including it in twice. We're deducting the tax benefit from our financial income, and we're adding to the tax expense for O. So we're reducing our F at that expense, and we're increasing, that's on the finance side, and on the operating side, we're increasing the expense, the tax. So we're just allocating, we're not putting it in twice. So what if things go wrong with restating our income statement? Well, you can check that the tax for operating and the tax for financing equals the original tax expense in your financial statements worksheet for your income statement. So check that the O and the F tax equals the original tax expense. Check that you haven't double counted items by including a subtotal as well as the items. Sometimes in your income statement, you've got, item 1 and 2, and they add up to an item, might be gross profit or something. And then that adds to something else, or subtract this, and there's various subtotals along the way. And a bit of a rookie error, really. We can highlight and just sum all of the items when we get to some total further down, but then we end up double counting the subtotal with the items that the subtotal has used to add up. So you've got to check you don't include the subtotals as well as the items when you're doing your totals. Otherwise, you'll be double counting certain items. Another way of checking whether you've got it right, it might all look pretty good. You can check that the operating income plus your net financial expenses equals the comprehensive income in your original financial statements. So the comprehensive income in your restated income statement should be the same, obviously, as your comprehensive income in your income statement in your financial statements worksheet. So you can check that nothing's happened there. If that's right, then you can think of it as your income statement's balancing. But if it's not right, you've made an error somewhere. And you can see this little structure. The comprehensive income equals your operating income, that's your net financial expenses. And then the operating income is broken up into income, expense, income, expenses, tax, and other comprehensive income. Other operating comprehensive income, and financing is income, expense, tax, and other financial comprehensive income. So if this doesn't balance, then you go back and you have a look to see where your errors are.
The most important thing I learned was that WACC can be called more than one name, as when I went looking for it, I thought I found it, but it was called something else. I can't even remember what it was called. So then I really investigated and I kept looking, trying to work out if it was indeed WACC. And then I thought, oh, I better check before I look too more into it.
That's good. So if you've got a bit interested and explored it, that's good. Yeah, WACC, weighted average cost of capital, we typically call WACC. And cost of capital for operations. So we have a cost of capital for equity. We have a cost of capital for our financial, for our debt, and then we have a cost of capital for operations. There are three cost of capitals. That's all right. What was the most important thing you learned today? Tyler, what was the most important thing you learned? Oh, here's Tyler.
Mine's a bit silly, but the whole thing of income not being a part of revenue, just as a general idea.
Oh, income not being the same as revenue?
Oh, so not being the same as revenue, yeah. That's what I was meaning.
Yeah. And so there are some items in income that are not revenue. Is that what you mean?
Yeah.
Yeah. So that was a bit surprising?
Yeah, and that's actually part of where I think I went a bit wrong in mine originally.
Yeah, we use revenue when we have the fundamental accounting equation, don't we? You know, we have assets plus expenses equals equity plus revenue plus liabilities. We don't use the word income, but in fact, in the conceptual framework in accounting, they use the word income, and income includes all gains that we make, not just revenue, but also ones that we may make in the ordinary course of activities. And so income is a defined term. It's defined in the accounting conceptual framework. But revenue is also defined. It's defined in its own accounting standard, ASB 15, revenue, and it's defined basically as gains in the ordinary course of activities. Well, we've seen the definition of revenue actually, we looked at before, which so there's that other comprehensive income is including the gains that are not in the ordinary course of activities, and those gains go straight to equity. They don't go via the income statement. Anyway, that's interesting. You don't have to get your mind around all this in introductory accounting, but these are some of the fundamental concepts we're looking at. So that's good, Tyler. So that was the most important thing you learned today. What else? Who else would like to say? What was the most important thing you learned today? Anita, what was the most important thing you learned today?
The tax calculation in ONF. I think it's easy for everyone, but for me, I took some time to figure out why I have to add the tax twice.
What, the tax rate?
No. The tax calculation in ONF. So one is increased expenses, one is decreased expenses.
Yeah, that's right. It's a bit confusing about the sign. Is that what you're meaning?
Not the sign. Just when I did the financial statement, I don't know why I have to calculate twice, but yeah, now I kind of understand.
Well, you sort of calculate it once, don't you, as the tax benefit on the financial side.
But you have to put it in like ONF.
2 places.
Yeah, right.
That's right. And so that's sort of where you're sort of asking yourself, am I putting this in twice?
Yeah, and at the beginning I wasn't sure why I have to put it twice.
Yeah. And so what we looked at that today, and so basically it's you can look at it as increasing an expense and reducing reducing the expense in terms of it reduces our net financial expenses, the tax benefit, and it increases the operating tax expense. So all we're doing is putting a number in, a plus in one and a negative in another, if you like, or however you want to do the signs. Yeah, so that's good. It is a little bit confusing. you're thinking, how come we're putting it in twice? But in fact, we're not. We're just increasing, we're reducing the net financial expenses for the tax benefit. That's the tax deductions we get for having those net financial expenses. And then we're increasing the operating tax. So that makes a little bit more sense to you, Anita, or not?
Yes, yes.
Yeah, that's good.
Mhm.
That's good. That's good. Anybody else? Sophia or David Tannum. What was the most important thing you learned today?
The variation in the financial accounts, I suppose. Variation in how they term things. They call it all different funny names for the same meaning.
And what do you mean exactly?
Like your assets and all that sort of stuff, they call it, and your revenue, how they state them without different documents, different financial statements, that sort of thing.
You're saying all the differences there are, both in
the variances in how they describe what they're doing.
No standard terms.
Yeah. And I find that funny because accounting, like they have the Australian accounting standards, but when it comes to financial statements, there's, no rule of thumb as such. There is, but there isn't.
Yeah, that's right. Exactly. Like when you look at the financial statements, it's a bit look like in people. They've sort of got, most people have got two eyes and a nose and a mouth. They've sort of got that feel about it, hasn't it? But just as we are so different, say all our faces are so different, it's sort of like that, isn't it? Financial statements are a lot different. People who know nothing about accounting think accounting is sort of just number crunching. It's all just, fixed. But then as you start to learn a little bit more about accounting, you realise there's a lot of judgments. There are enormous amount of judgments. We're just introducing you to it. But when those who are studying accounting, and you'll get into a lot of technical detail as you progress, you'll discover that it's full of judgments. And we've got a little bit of a flavour of that in this unit. One of them is you've got to decide what you're going to call items. And there's a lot of flexibility there. And there's nobody telling you what word means what. So you can use the same word for different things, or you can use different words for the same thing. And so, you found that a little bit, I think you found it a little bit intriguing.
Yeah, intriguing and somewhat intimidating, depending on the company and how they derived their conclusion to what they call things, I suppose.
Yeah, like when you're first getting used to financial statements, you say to yourself, well, wouldn't it be better if everybody just used the same word for the same thing? That would make life a lot easier?
It would make sense, but I can understand why they do it. I mean, when you look at a certain type of firm and the way they operate, I can understand why they call it different things, but it doesn't help the student reader. Let's put it that way.
Like most people are just looking at financial statements more or less for the first time, It doesn't help that the terms are all over the place. And so that's right. It's sort of confusing and a bit intimidating. It makes it harder for you to get to know the financial statements.
Yeah, I think if you understand the process holistically, it's easy enough to work out. But thank God for notes in financial statements is all I can say.
That's right.
Yeah.
And that's one thing you've learned is that you can look at the
absolutely notes. Yeah.
But you just look at the individual items and then the notes if you want to know more about them. Also, there's a very big footnote that's not called a note, called all the accounting policies. We're not looking at it in this unit, but if you're studying accounting, get into more technical detail, there's a lot of stuff in the policies about how the treatments, the way they're choosing to treat different items in the accounts. There's a lot of choices and judgments people can make in how they value things. Inventory, property, plant and equipment, everything. There's a lot of choices in a lot of areas and most things. And so there are judgments in the accounts receivable. and there's judgments in the cash and cash equivalents a little bit. So they're everywhere. So one of the things that you might be saying to get a feel for is that there are shades of grey in accounting. There are judgments. And it would be nice if everything was nice, clear cut. But why, David, do you think the accounts aren't clear cut like that? Why are there all these shades of grey?
Because of the way they're operating the business and the way that, I suppose, in my, my view, the way that the business is operating, if they're trying to, I suppose, write down a particular part of their business or talk up a particular part of their business as such. Especially with the ones that are the companies that are capital raising and all the rest of it. You notice what they're trying to do. Okay, they're trying to raise capital so that they can expand their business because they've got a business plan that they think is going to work moving forward for the company, and it'll produce an end result for the equity partners. And that's the grey area, isn't it?
Yeah, in accounting, we don't put projections for earnings and all that sort of stuff. They're not in the accounts. There's not a lot of projections in accounting. So there's a lot left out of the accounts. A lot of value is left out because of that. And that's the main reason is for the reason you're suggesting, management would be so tempted to just spin stories. But we make a lot of judgments on the things of the present and, just the current in the accounts. The reason for this is that every business is different. You've probably seen that, if you compare Ryman Healthcare and Wesfarmers, they're very different businesses. You might compare Ryman Healthcare with your business, and as you look at other people, they're all so different. It's very, very difficult. I mean, you could, but it's very difficult to have a clear-cut fixed rule for everything that applies to every company. We could do that, and if we did, that would mean there wouldn't be judgments. You just have to, or very little, you just have to follow the rules regardless. The problem with that is that some of these rules may not work very well for some firms in terms of helping us understand what's going on in the business, because they're just not appropriate. They just don't work. So in the accounting standards, there's quite a lot of scope for people to make judgments. And the idea is that you make the judgments. You've got the accounting standards, and there's sort of general, there's sort of, there's a sort of a bit of a boundaries around what you can do. But within that, there's a lot of scope for judgment. The idea is that you use the judgment to help the accounts be better used to engage with what's really going on in the firm. It's a true and fair view. That is the ethical obligation of accountants. It's to make those judgments in a way that help people to see what's really going on. You don't make the judgments in order to spin stories that management want to tell people like investors or other people. That's the ethical issue for accountants. So there's some good stuff there, Daniel. David, you can keep thinking about that. Did that answer the question a little bit? That was the most important thing you learned?
Yeah. Moreover, I just look at the history, my work history and all this sort of stuff. And the reasons why I provided budget forecasting to asset managers and funds managers and all the rest of it, as well as your up-to-date profit and loss and all the rest of it, your full statements of exactly what you as a business entity are doing. But why they wanted the forecast stuff if they're just gonna, if they're just going off the financial statements for a given year and they're not trying to forecast anything, not trying to predict anything. Maybe they're trying to get my reassurance that everything's okay. I don't know.
Oh, you're giving some forecasts, and they'll be typically for a short period of time, like a year or so. Is that what you were doing?
Yeah, mate. Yeah.
So you might make a quarter, a year, a short-term forecast, right?
Yeah.
And you'd be giving them to people in the market and stuff. And now forecasts they typically don't happen exactly as you're forecasting, But if what actually happens is quite different to what you forecast, then you better have a pretty good reason why that happened for something you couldn't have known of, like COVID happened or something, bang, you had some nuclear holocaust or something. But if they're concerned that you were telling them some sort of story, that wouldn't go down well. So the forecasts are very short term. You're not forecasting long term, but that's right. But they're not in the accounts, the actual formal accounts.
No, not in the accounts, but
forecasts in addition. That's right.
That also answers the reason why I provided two. I provided a stretch forecast, a stretch budget that my team had to achieve, and the actual, and a realistic forecast within reason of the actual financial.
Yeah, so you might have a range of forecasts. You might have a stretch one, a sort of one you find would be, pretty more conservative, and you're more confident you could.
Yeah.
And perhaps a bad scenario, as if something really bad happens, this might happen in the range. So you could do that too. Yeah, it's interesting. What questions remain unanswered? That in Chapter 5, managers need to monitor their costs. Yeah, so on the chat, people are thinking ahead. We're going to be moving into management accounting, and we're going to be, Chapter 5 is a really worthwhile chapter to read, and it sets up chapters 6 to 8. It gives a bit of an overview. So today we looked at restating, why we do it. Well, a reminder that we're doing it to help us get to know our financial statements better. You can get to know, here's some of my friends, and you can get to know them a little bit better by restating, moving the items around, deciding which are operating and financial, moving around into operating and financial, just to get a little bit more used to what these items are, and tips in the income statement, restatement. All right, well, thank you very much, everyone. Bye for now. Bye-bye.